All right, so good evening, everyone. So the topic we are taking this evening is IAS 37. So IAS 37 is all about provisions, contingent liabilities, and contingent assets. So what this implies is that we'll be looking at three different issues under IAS 37. The first
Mr.
one,
Kazeem, I can't admit them in.
what is the issue? Okay, I've done that. So we will be looking at three different issues under IAS 37. Kenny seems to be having issues with his network or her network. So the first issue that we'll be addressing is provisions. The second one is the contingent liabilities, while the third one is contingent assets. So let's look at the three of them, right? We'll look at them one after the other. So we'll be focusing on the first one, which is a provision. So remember that anytime you are making a provisions, right, it is always a liabilities that you are trying to create. So the debit entry for every provision is always to P or L. So the debit entries for every provision is always into your P or L. So you are increasing your liability. So that is why provisions are liability. So they are called liability. And they also, because they are provisions, is because of the uncertain timing or amount. Okay, you know that you will incur the outflow, but you don't know the exact time the outflow will be incurred, and you are not too certain of the amount of the outflow, but you can give an estimate. Okay. Just a minute. Let me quickly pick this call. Apologies for that. So, like as I was saying, that is the provisions because of two things. Number one is that the uncertain timing, and the number two is the amount. So you don't know the exact time that the outflow will be incurred. However, you can predict, you can guess. Likewise, you don't know the exact amount. However, you can also give a reliable estimate of the amount. So that is why it is a provision. So provision basically are liabilities of uncertain timing or an amount. Okay, they are liabilities. So all provision basically are liabilities. So for every provisions that you create, you are increasing, you are reducing your profit and increasing your expenses. Whenever you create any provision, you are reducing your profit and you are increasing your expenses. And the second leg of every provisions goes to your liability. So for every provision, you debit your P or L, okay, and you credit your liability. Liability is the provision you are creating. E.g., if you are creating provisions for salaries and wages, so that means you debit your profit or loss staff cost and you credit your salary payable. If you are creating provisions for electricity bill, you debit your power cost or electricity expenses and you credit your electricity payable or the name of the vendor that you are supposed to pay. So that is how you account for what provision. So the objective of IAS 37 basically is to set out the principle, okay, is to set out what the principles that must be followed when creating a what provisions, because you know what, these provisions can be used to window dress financial statements. Provisions can be used to window dress financial statements. So if I want to increase my profit, or if I want to reduce my profit, all I need to do is just to create provisions, right? I will just create one unnecessary provision. So I can use provision to window dress my financial statement. If I want my profits to reduce this year, I will just create one fictitious provision. With that, it reduces my profit, right? And if I want to increase the profit back in the following year, all I need to do is to go and reverse a provision that I have created. So what I'm saying is that you can use these provisions to do a whole lot of window dressing. Okay, you can use provisions to window dress your financial statement. So IAS 37 now came on board to address all these issues of window dressing surrounding provisions. So IAS 37 basically address the issue of window dressing surrounding provisions. So being that is made, let's look at the major accounting issues governing this provision. So there are basically 3 accounting issues that we should be able to address at the end of this lecture. The first accounting issue is whether or not a provision should be recognized. So now, okay, just give me a second, please. Let me, somebody is knocking at my door. I'm actually very far away from you guys, so I have somebody at the, let me ascend to him. Solomon. Yeah, I'm coming, Mr. Solomon. Let me open the door. All right. So back to class. Okay. So like I said, there are basically 3 major accounting issues that we are going to address, okay, at the end of this course. The first one is whether or not provision should be recognized. That's the first thing. So we should be able to answer that question because IAS 37 gave us some strict rules that must be followed before we can recognize provision. So that these questions will be answered with the recognition criteria. So once we are done with recognition criteria, you should be able to answer whether you should create a provisions or not, right? So that's the first issue that we are going to address. Then the second one is how to measure a provisions that is recognized. So which means that if you have recognized a provision, so what value are you going to place or how are you going to determine the amount to set aside as a provision? So that's the next question that we're going to respond to based on the principle of IAS 37. So the first one is the recognition criteria, whether or not you should recognize a provision. Then the second one is how to measure, that is how much, what is the value. Then the third question is what is the double entry that is required? Okay, now that you have agreed to recognize a provision, so what are the various accounting entries that is required for that provision? So those are the 3 questions that we should be able to answer at the end of today, okay, when we are done with all the various details we have under IAS 87. So let's discuss the first one, whether or not to recognize the provision. So that will take us to what is known as recognition criteria. So ladies and gentlemen, so before you can recognize provisions, these 3 conditions must be certain, okay? The first one is that a company has a present obligation as a result of past events. What it simply implies is that there must be an obligation. E.g., just assume that you are walking on the road now. Somebody just probably call you, Oga, pay me my money, pay me my money. The first thing you ask the person that, what service did you render for me that I have to pay you for, right? So, because before there can be any provision, there must be a past event, right? So that past event could either be a legal or constructive. So I'm going to spend a little time to explain the meaning of legal or constructive. So obligation. So without an obligation, there can't be a provision. However, your obligation could either, it can be in form of a legal obligation or a constructive what? Obligation. So when we say legal obligation is something that has been documented. It could be in form of a law that is passed by the federal government, or you have an agreement that is signed. That is, there is a paper backing it up. This one is referred to as a legal what? Obligation. So legal basically means something that can be enforceable. It is enforceable in the court of law because there is a document or something has been signed, an agreement has been signed. That is why it is called a legal obligations. Then the second one is constructive obligation. Now, this constructive obligation, remember there is no document signed here, but because of your past action, or behavior, you have already created a valid expectation that you will fulfill the obligation. E.g., in your company now, every year, you normally announce best half of the year, right? Whoever, and the criteria for selecting the best half of the year is probably if you are the highest performer in terms of sales. So every year, you used to give the best half of the year a car every year. You have been performing that obligation previously. In fact, once you have done that, you will do a newspaper publications that, oh, this year, Mr. ABC was our best half of the year. He won a car. You know, you are making this announcement known to everybody, even though you do not have any policy you did not document that you'll be given a car, but because you have been doing that every year. So if this year I am the best half of the year and you refuse to give me my car, I can claim that because of this constructive obligation, you should give me my car. And to some extent, it is enforceable in the court of law. So you need to be very careful with what is referred to as a constructive obligation. Because if you have been performing an action in the past through which you have already created a valid expectation that such actions will be, you will continue to honor the obligations, then that might warrant what is referred to as what a constructive obligation. But legal obligation, that one is straightforward. The document is signed, there is an agreement, either it is a law or something. But for constructive, as long as you have created a valid expectation through your past performance, then you can trigger a constructive obligation. So this is one of the first conditions that must be fulfilled before you can create a what? A provision. There must be an what? Obligation. So this is the first thing that must be fulfilled. So once there is an obligation, then it must be probable. Okay? It must be what? Probable. Just few seconds, a minute. All right. Okay. Yeah, because of your class now, I'm unable to go and club with my friend. Yeah. Auntie Jamile. Okay, let's move on. They don't Jamile. All right, let's move on. So the first one is the obligations, right? So we've already explained the obligation, that the obligation could be in form of a legal or constructive. So legal is the one that is documented, while constructive is not documented, but through your past performance, you must have created a valid what? Expectation that you will continue to honor the obligations. That is what is referred to as what? A constructive obligation. Okay? So that's the first one. Now, the second condition. So I hope we are clear with the first one, please. Once I'm done with these three, it's like we are done with provisional. So I need your feedback. Are you okay with the first explanation before I move for the next one?
Yes, sir.
Okay. All right, so that is the first thing. That is the first thing. So the first condition is this. So once there is an obligation now, the obligation could be in form of a legal or constructive. Then you now move on to the next one, which is this, that it is probable, that is, it must be probable that an outflow of economic resources will be required to settle the word obligation. So what this simply means is that whatever provision you are creating, it must result into a future cash outflow. Okay, it must result into a future cash outflow. So if you want to create a provision and that provision will not result into any future cash outflow, it's not a provision. Don't waste your time. You are just window dressing. Okay, if the provision that you want to create will not result into a future cash outflow, you are just window dressing. So whatever provisions that you want to create must result into a future cash outflow. So that is very, very important. So it is probable that an outflow of economic resources will be required to settle the what? The obligation. That is, it must result into a future cash flow. What you see in bold here, I was the one that tried to summarize a long grammar for you. You can see the first one I said, there must be an what? Obligation is my summary. So the obligation could either be constructive or what? Or legal, right? Then the second one is that it will an outflow of economic resources will be required. That is, it must result into a future cash outflow. Then the third one is that a reliable estimate of the amount can be made. How much? You should be able to determine the how much. Okay, what is the amount? You should be able to give a reliable estimate. Okay. What is the provision that the first thing is that your accountant, your FC called you. Accountant, create this provision. You need to ask your boss these three questions. Hello, sir. Do we have any obligations for creating this provision? We have obligation because of ABCD. You tick that box. Okay, obligation test, pass. The second one is that, okay, sir, are we going to pay this amount? Is there any certainty that we are going to pay? Yes, sure, we'll pay. Once the outflow too has been checked, you tick the box. Then the third one is, okay, sir, how much is involved? And if the accountant if the OFC tell you the amount involved is 6 million, and how did you arrive at the 50 million, sir? You should ask, oh, we use this. If you are certain you tick, then you can now create your provision. So don't behave like dummy accountant that somebody will just ask you, create this provision, you will not even know what is meant for. You should be able to ask these three questions, right? So the first question is check whether there is an obligation. The second one is that will it result into a future cash outflow? And the third one is that can we determine how much is involved? So these three conditions are very vital before you can create any provision. And guess what? If answer to any of these three is no, you cannot create a provision. Okay? If answer to any of these three questions is no, you cannot create a what? A provision. It is either a contingent asset or a contingent liability, which we are going to discuss later. If answer to any of this is no, you can't create a what? A provision. So that is very, very important. Okay, so that is very, very important. So now that we've been able to explain the three conditions, now let's advance. So I've explained the obligation. However, you can do a further reading on it. I explained what is a legal obligation, that is whether you have a contract or it is already in the law. I also explained what is a constructive, probably because of your past action, your past behavior, your previous policies through which you have already created a valid what? Expectation. So that is what is referred to as constructive. So obligations may not necessarily be legal. Let me use a guy and a girl in the class as an example. Now, you girlfriend, Mrs. Girlfriend or Madam Girlfriend, there is a guy that you have been collecting money from him every time, that you promise him, don't worry, it is me and you forever and ever. 5 years, you are still dating him, you are collecting his money, doing everything. Now, when it is now time for the guy to now say, Madam, oh yeah, let's go to the altar, you now say no. The guy can sue you because of constructive obligation. Okay. If you are not interested, you shouldn't have even been collecting his money. Because you have been collecting his money all this while, you have already created a valid word expectation. I hope you are understanding me. So if you're on that table that I'm shaking now, please repent so that I won't sue you for breaching of constructive obligations. Okay. If you are not interested, be plain from day one. So that is just the end of my sermon on that. So if you are the ladies on that table, please adjust. All right. And vice versa too. Okay. So we've already explained the recognition criteria. So please, is there anyone that does not understand any of these three recognition criteria, please? Is there anyone that does not understand? I'm waiting for your feedback. Who doesn't understand?
We understand it.
Okay. All right. So let's move on. So we are done with the recognition criteria. Now the second question is measurement of provision. So that is, how do you measure a provision? How do you measure provision? So according to IS 37, because it is a provision, you call it a provision because you don't know the actual amount, right? You don't know the actual amount, but you should measure it at the best estimate of the expenditure required to settle the obligation. For example, you should measure it at the best what estimate. E.g., you want to pay NEPA bill now for the month of February. However, you know NEPA will only bring their bill maybe in middle of March, and you need to provide for it in your management account. So what you can simply do is, okay, how much did you pay in January? We pay this amount, so you can repeat that amount, or you just adjust it with inflation and use it as provisions for February. So this is just an example of how and determine your provisions. So you can use how much you pay in the previous year adjust it with maybe inflation and recognize this as the current provision. At least whatever amount that you want to recognize as a provision, you should be able to give us the best estimate of the expenditure required of the amount. So your provision is usually based on the best estimate. So the next thing that we are discussing, want to discuss now, is how do you treat reimbursement? Now, so this reimbursement is very, very important. So there are some companies there are some organizations that probably they have a partner. Let me give you an instance now with one of the companies in my group. So we have the right to sell a particular brand of products in Nigeria, correct? However, the OEM, the people, those that owns the product, they are not based in, they are based in China. But there are some expenses that these people will authorize us to incur in Nigeria, which they will later reimburse us. They can say, okay, oh, you can be repairing all products for people free of charge that are under warranty. Whatever amount you incur for warranty, we will pay you back. So so what I'm trying to say is that, so whenever you incurred any outflow that will be reimbursed by a third party, then such an outflow, don't take it as an expenses. It is called a reimbursement. Okay? Whenever you incur any outflow that is recoverable or that will be reimbursed by a third party, such an outflow is not an expenses. It should be referred to as a reimbursement. So how do you treat a reimbursement? Simply, so your reimbursement will be shown under your current assets. Okay, it will come as a separate line under current asset, e.g., it will come as a separate line under current assets. Okay. Okay. So whenever you incur an outflow, that will be reimbursed by a third party. So such an outflow is not an expenses. It is known as a reimbursement. Okay. It is known as a reimbursement, and such reimbursement will be treated as a separate asset. So, e.g., you have been PWP incur some expenses, and that expenses ICANN will reimburse PWP. Okay, ICANN said, okay, PWP spend this amount and submit your invoice, we'll pay you back. So when PWP is incurring that expenses, PWP will debit an account called claim from ICANN and credit their bank. So you can see that PWP will not debit expenses. What PWP debited is claim from whoever that want to reimburse. That is ICANN. Then they will not credit, PWP will not credit bank. So once you incur an outflow that will be reimbursed by a third party, such an outflow is a reimbursement. Okay. So, however, before you can recognize a reimbursement in your financial statement, IAS 37 gave some rules that you must follow before you can recognize a reimbursement. So the first rule is that IAS requires that such should only be recognized where receipt is virtually certain. You should recognize a reimbursement where the receipt is virtually certain. So when you are sure that such an amount will be received. If you are still doubtful, oh, they may pay or they may not pay, then cuckoo expenses, don't waste your time. But it should be recognized as a reimbursement when you are certain that the amount will be reimbursed. Okay, that is the condition. And also, once you have taken that, you should treat it as a separate asset. I've already explained this. That is, you take it as part of your current asset, which is you debit the claim from whoever that is reimbursing you. So that is just how you recognize a reimbursement in the financial statements. I don't know whether do you understand this treatment of reimbursement, please, ladies and gentlemen, so that you don't go and be committing blunder in practice. Whatever I'm teaching you is beyond I want you to know this thing for the purpose of practicing. So I hope the treatment of reimbursement is clear, please. Oh yeah. I want to move on. Are we cool with the treatment of reimbursement, ladies and gentlemen?
Yes, sir.
Okay, thank you.
Yes.
Thank you. All right. So I have a small question to discuss here. Just to double entry on provision, this one just for me to test whether you truly understand all the grammar I've been speaking since. So just a minute, okay. Okay, so solution. PWP PLC is in the process of preparing management accounts for the month ending February 2023. The company management accountant is mandated for electricity bill for the month of the company management accountant is mandated to provide for electricity bill for the month of what? February. That means the accountant want to make provisions for electricity bill for the month of February 2023. However, the actual bill for the month of 2023 was received on 13th of March, totaling 24,000 naira. So this was received in March, and the actual amount paid in January was what? 20,000. Show the double entries for the electricity bill for the month of February. So now look at these scenarios now. Look at these scenarios. So we want to provide for electricity bill for the month of February, right? However, as at 28th of February, we don't know how much is the electricity bill because the electricity bill for the month of February itself was received in March, Abi. However, we know that in January we paid 20,000. So what you can simply do here is that your provision for as at 28th of February, okay, as at 28th February, you can make provision for February 2023 electricity bill using the actual amount paid in what? In January, Abi? So how do you do that? You just debit your P or L. How much did you pay in January, please? We paid 20, Abi. Am I correct?
20,000.
Hello, am I correct?
20,000. That's what we paid in January.
Am I correct?
Yes, sir.
People are not speaking. Oh,
Yes,
sorry, are you
sir.
guys with me? Am I alone here?
Yes,
I
sir.
am
Yes,
correct,
sir.
Abi.
Yes,
Yeah.
sir.
Yes, sir.
Okay, so when we are making provision at the end of February, you remember that the February bill was received in on March, Abi, and we are not a ghost, or we are not we are not an angel that will know that in February this is what we will receive. We can only make estimates using January. Now that we are as at the end of February now, we have made provision for electricity bill. So now we can close our management account saying that this expenses has been provided for. Okay, so this is what you would do in February. Now, you now receive the actual bill on 13th of March, Abi. On 13th March, actual bill is how much? That's 20 what? On 13th of March, the actual bill is what? Is 2024, Abi. Now, how will I account for this now? Remember, my provision was how much? 20,000, which was used in closing my books for January. But now that I've received the bill, the actual bill is just what? 24. So there are two ways of treating this thing. A, you book the differential. Book the differential in provision. Okay. Second method, reverse the initial entry and book the actual. So you can use any of these methods to correct this now. So if we are to book the differential now, we will just say debit P or L with how much? That's 4,000, Abi. That's the actual, that's the 24,000, which is the actual bill, minus what? The provision of 20. That's 4,000, Abi. Then you credit your, you credit your, now you know the actual, so you are paying. You credit your bank 24, Abi. Then you debit your electricity payable. You debit your payable with how much? 20. Remember, this payable, you already have 20,000 lying there. So now you are paying 24. So the difference of 4 is what we took to where? To pay or help. I hope you guys are getting me. You already booked 20 before. So
Yes.
you try that 20 you pay. You are paying 24. So the difference of 4 is what we took to pay or help. Now, the second one say you should reverse the initial entry. So if you want to reverse the entry now, so this entry now, we will completely reverse it. So by saying debit electricity payable, debit electricity payable, 20,000 abi, then credit what? P or help, 20,000 abi. Then we will now book the actual. So what is the actual now? 24. So we'll credit our bank 24 and debit. We'll credit our bank and debit the what? The electricity. Debit P or L, right? Okay, so this is what you do to reverse the entry and book the actual. So, guys, which of these two methods do you prefer? A or B?
A.
Oh yeah, A or who are the team A and who are the team B?
I prefer the A. Is simpler.
You prefer the?
I prefer the A. Yes, it's simpler.
You just book the differential and move on, Abi?
Yes.
Okay. Who else
Yes,
again?
A is better.
Not team B here.
Yes, sir. Let's go for the A. This B is
A is
somehow.
better.
Are you mandating me to go for A, or that's what you feel that is right to you?
I think this one is just
At the
forward,
both
not
of you.
to.
Okay, B is simple now. You reverse the initial entry, then you post the actual expenses. What is there?
It's not simple. And sir, if it was reversal, that electricity payable that we are debiting, if it's reversal, should be to be credit.
No. See, in your initial entries here, you have see what you have done initially. Now you credit it, so you are debiting it back.
Okay.
You are
Okay.
reversing the initial. See, let me tell you the benefit now. If your transaction is very few, you don't have plenty journals, your transaction is not, your volume is not much, then you are safe with option A. If your volume is not much, you are safe with option A. Okay? If your volume is not much, you are safe with option A. However, if you have large volume, if you have a very large volume, you are not good with option A. Option A will make it difficult for you to reconcile your ledger. Okay? So if you have a very large transaction, rather you should go with option B so that you can always compare debit versus credit. You can compare debit versus credit. So option B is good for those with large transaction, while option A is good for those that have a very few transactions. So that's just what I would say. All right, that's for that. Let's move on. So guidance on specific provisions. So let's look at the guidance on specific provisions. So disclosure. So for every provision you have to disclose basically. So the first thing you do is that you show the opening and closing balance on provision. You know what you recognize in your P or L is the movement in provisions. That is the difference between your closing and opening. It's what you recognize in P or L. It is the movement that goes to the P or L. That is the difference between your closing and opening. So you also explain the nature of the obligation, the expected timing. So these are what you disclose in your provision. So let's discuss this guidance. After we are done with this guidance, we'll look at the contingent assets, contingent liabilities, and we'll take our question. So I have a couple of questions. All right, so let's move on. So guidance on specific. Anyway, wherever I stop at 9, wherever we get to at 9, we'll stop. So we'll just pack the rest to Saturday because I need to attend to something else by 9. And it's just 15 minutes to 9. So let's move on. So guidance on specific provisions. Guidance on specific provisions. So the first one is Is this onerous or onerous? Anyway, anyhow you want to pronounce it. But this is what I want to call. I will pronounce it as onerous contract. So this onerous contract, I normally refer to it as a bad market. Okay, I normally refer to as a what? A bad market. So it is a contract whereby the unavoidable cost of fulfilling or completing the contract exceed the what? The benefit to be received. Okay, whereby the cost of fulfilling the contract exceed the benefit. That is the meaning of what? Onerous contract. Let me give you an example. Now, you want to organize BB Niger next year. Okay, you have announced that your total price is 50 million naira that you are going to give out. Your total price is 50 million naira. So you have now invited people to come for audition. So you have already anticipated that at least you have about 20,000 people will come for audition, and each of them will pay, let's say, 10,000 naira each. Okay, you have expected that 20,000 people will come for audition. Each of them will pay 10,000 naira each. So if we multiply 10,000 by 20,000 people, that will give us about 200 million.
200 million.
Yes, and the total prize money is 50 million. So you now say that, okay, 200 million minus 50, you make a profit of 150. This is what you have planned. So you have already announced this thing. You have done the TV. You have already purchased the price. Everything is, you have already gotten the approval from the government or the agency handling such. Now, when God now wanted to catch you now, out of 20,000 people that you are expecting for audition, only, let's say, out of 20,000 people, only 2 people show up. Okay, 2 people show up, and each of them pay 20,000 naira. So you are expecting a revenue of 200. However, only 2,000 people showed up. You made about 40, and your cost is already 50. So the question is, can you now cancel the show before people refuse to turn up? Most likely no, because once you make those things no, you cannot cancel, because you must show, the show must go on, like they used to say, the show must go on. So now you have not even started the show, but you already realize that you are going to make a loss. So that is what we refer to as what? Onerous contract, whereby the cost of fulfilling the contract exceeds the benefit to be derived from the contract. The cost of fulfilling the contract exceed what? The benefits to be derived. That is what is known as what? Onerous contract. So based on the principle of IAS 37, you should make provision for onerous contract immediately. Okay, you should make provisions for what? The unavoidable cost of an onerous contract. You should make provisions for it. A provision should be made for the unavoidable cost of the onerous contract. So that is how you treat your onerous contract. So you provide for it. Now, the next one is future operating loss. Now, it is some company, it is when there is, when if some company at the beginning of the year, the original this year we cannot make profits. This year is going to be a loss. The question is, can they now make provision for the anticipated future loss? So the answer is no. You cannot make provisions for future loss, because they are from future events and not a what? A past event. Remember that provision is usually made for past event, not for future event. So you cannot make provisions for future operating loss. You can only make provision for past event and not a what? A future event. So that is for future operating losses. So you cannot, so onerous contract, you can make provision. Future operating losses, no, you cannot make provision. Then the third one is restructuring. Now, what is a restructuring? What is a restructuring? So restructuring involves a whole lot of things. It could be as a result of sales or termination of a line of business, closure of a business operation in a country or geographical region, or it could be changes in management structure, or you want to shut down somewhere and you will sack people. So the question is, can you provide for restructuring? Can you provide for, who is this person coming and going every time? Kenny, just keep coming and going. So can you make provision for restructuring? The answer to that is yes. For you to make provision for restructuring, then you must have communicated the plan. Okay, there must have been an obligation. Obligation simply means that you must have informed your staff ahead that, oh, dear staff, we are closing down our factory in 3 months' time. So you have already informed everybody. So if that is the case, then you can make provision for restructuring costs. Okay, that is why the standard says that a provision can be made for restructuring costs if a present obligation or constructive obligation exists. So you can provide for restructuring costs. Then the next one is decommissioning liability and similar provision. This is similar to what you did under IAS 16, whereby if you install an asset, you will need to clean up the asset at the end of the useful life or when the asset will no longer be used. So you can make provisions for decommissioning liabilities as well. Okay. So if it is required by law or you have already signed an agreement with your landlord that, see, when I'm exiting your building, whatever thing I've erected, I will remove everything. So you clean up your site. So you can provide for it. In fact, when you are reading the question, you will understand the tone, whether you should provide or not, because there must be obligation, either in form of a legal or constructive obligation. Then the next one is future repairs to asset. Now, you want to repair your asset in the future. The question is, can you make provision? The answer is no. You cannot make provision for future repair or future losses because they are from future events and not past. What if you change your mind that you're not doing again? So you can't make provisions for future repairs to an asset. Okay? So that is so you need to understand each of these things very well. Let me repeat again. Onerous contracts, where the cost of the contract exceeds the benefit, you can make provision for all the unavoidable costs in an onerous contract. Future operating losses, no, you cannot make provision because it is from future events and not past event. Restructuring, yes, but we must have done the necessary communication, okay, before we can provide for restructuring. Decommissioning liabilities and similar provision, yes, we can. It's in line with the provision of IAS 16. Future repairs to assets, no, we cannot make provision for future repairs to assets. So this is all you need to know, okay? So let's move on to the next one now. All right, so the next one that I want to talk about is contingent asset and contingent liability. So when we say contingency, anything contingent simply means that they are those things that are outside your control. Okay, they are not fully within your control. E.g., if you have a case in court now and somebody has sued you asking you to pay for damages, so that is a contingent liability. So that is not within your control. And the same way, if you sue somebody, you are expecting the person to pay you a certain amount. That is a contingent asset, which is also not within your control. It is 50-50. So a contingent liability is a possible, because it is 50-50, that is why the word possible is used, okay? It's a possible obligations that arises from past events and whose existence will be confirmed only by the occurrence or non-occurrence of one or more or certain future events, not wholly within the control of the entity. So anything contingent is not within your control. It is 50-50. So contingent asset is the opposite of contingent liability. So this is a possible asset that arises from past events whose existence will be confirmed only by the occurrence or non-occurrence of one or more certain future events, which is also not within the control of the entity. So both contingent and asset and contingent liability, they are not within the control of the entity. So you don't recognize contingent asset and liability in your financial statement, or you don't recognize them in the financial statement. So what you do to contingent asset and liability is you just you disclose them, okay? You don't recognize contingent assets or liability in the financial statement. However, you should disclose them, okay? You should disclose them, but do not recognize. All right, so I am done, ladies and gentlemen. So I think we should I want to stop by 9. So we still have about 10 minutes. So let's take 1 or 2 questions. We'll call it a day. Then I promise that on Saturday, I will close the rest question for you. Okay, on Saturday, we'll conclude our foreign subsidiary. We will take the joint arrangement and the outstanding questions with this. So we have a lot to cover on Saturday. All right. So can somebody read question number 1 for us, please? Somebody should read for us.
Ogbomoso Clothing has a contract to buy 300 meters of silk from a supplier each month for 3,000 naira per meter. Ogbomoso Clothing has a contract with a Dubai retailer to sell each dress for 5,000 naira each, but this retailer has fallen into administration and the administrators have cancelled the contract as they were entitled to do under one of its clauses. Ogbomoso Clothing cannot sell the dresses to any other customer. The contract to buy the silk can be cancelled within 3 months' notice. Calculate the amount of provision to be recognized.
Okay. All right. So the company name is Ogbomoso Clothing, right? Ogbomoso Clothing had a contract. Ogbomoso Clothing had a contract with a Dubai retailer to sell each dress for 5,000 each. But this retailer has fallen into administration and the administrator have cancelled the contract as they are entitled to do so under one of its clauses. So, okay. Ogbomoso want to buy 3,000, is it 300? Yeah, 300 meters. So, Ogbomoso Clothing cannot sell this dress to any other customer, and the contract to buy the silk can be cancelled with 3 month notice. So, calculate the amount of provision. So, do you really understand this question, ladies and gentlemen? They said Ogbomoso has a contract to buy 300 meters of silk from a supplier each month for 3,000 naira. So, Ogbomoso will buy a particular material for a supplier, okay? He will buy 300 meters every month for 3,000 naira. And that material is required for a particular dress. However, the person that we want to make that dress for has fallen into administrator. The person said, I don't want the dress alone. However, I cannot cancel my contract until after 3 months, which means that I need to keep buying the materials for 3 months and probably destroy or do something for it. So what do you think happened here? Can you tell me? Oh yeah, guys, let's tell me now. What do you think happened here? Or advise me on what to do. Oh yes, Soro. Oh, you don't understand? Hello?
Sir, explain it.
You don't understand, Abby?
Yes.
Yes, sir.
Okay, I should explain it again, right?
Yes, sir.
Okay, let's go again now. Ogbomoso Clothing has a contract to buy 300 meters of silk from a supplier each month, okay? Each month for 3,000 naira per meter. Now, Ogbomoso had a contract with a Dubai retailer to sell each dress for 5,000. But this retailer has fallen into administrator, and the administrator have cancelled the contract under one of the clauses. Ogbomoso cannot sell the dress to any other customer. However, the contract to buy the silk can be cancelled with 3 month notice. So this material silk now, we are buying this material every month. So the purpose of buying this material is to make this dress for Dubai retailer. Now, this Dubai retailer now has cancelled the contract. They said they are not doing it again because one of the clauses in the contract shows that they can cancel. And we're not told that this dress, once we made it, we can't sell it to another person. And the material encore, we must buy for 3 months. So what is the issue here?
It means that like we have the dress, but we don't have anybody to sell it to.
Correct. So what do we call this? What do we call
It's
this?
bad debt now. Is it provision? Like, since you don't have anybody to sell it to.
It seems many of you are not with me. I don't know what's happening this
This
evening.
contingent
Eh? Goodness.
liability.
What?
I think it's the
What is
liability.
this? Is an onerous contract now.
That's true. That's true. Yes, yes.
Onerous contract because you are going to buy this material for the next 3 months and you will destroy it. Reason being that the person that you want to make the clothes for sale is not buying the clothes again, and you cannot cancel the contract to buy the material. So you will buy this material for 3 months and destroy it. It is an onerous contract. Okay, you are going to buy this material for 3 months, right? You with the intention that you will sell it to this person in Dubai at the rate of 5,000 naira. But this Dubai person has fallen into administration and they have cancelled the contract. They have cancelled the contract with you that they are not buying again from you. So you don't have any other option than to, and you must buy this material for 3 months. They say that the contract to buy the silk can be cancelled with 3 months notice. So it is simply an onerous contract. Sorry, do you understand that, please?
Yes.
Yes, sir. Yes, sir.
So the amount of provision is simply the cost of material you buy for 3 months. So amount of provision, which is equal to 300 meters, Abi, multiplied by 3,000. You buy this material for 3,000 per month. Then number of months is 3 months. So how much is this? So you will buy this 300 meters for 3,000. You buy it for 3 months and you will destroy it. That's all. How much, please?
2.7 million.
So this is the amount of provisions that you need to make in your book as onerous contract. Okay, it is an onerous contract. So, I actually have. When I'm done with you on provisions, all these questions, you will not have problem again in your exam. But there are about 7 questions, but the feedback I'm getting from you guys is not encouraging. So what will happen is that I will stop here. I won't continue any other things now. So you have the between now and Saturday to listen to the lecture all over again. Then you read this. I will send this material to your WhatsApp group now. Read this material. So when we meet on Saturday, I'll just conclude the remaining question. Is that a deal for us, please? I don't want to rush all these things now. Is that a deal for us?
Yes.
Yes, sir.
Okay. Let me stop recording now so that I will share this link with you. It won't be that large. So please, it's just about 40 minutes recording.